Hello and welcome to SCI's video series to support the Accounting Foundations course. My name is Eric Andrews, and in this video we're going to be talking about the basics of the accounting equation. So, let's get started. What is the fundamental accounting equation? Well, if you're scratching your head, that's not unexpected. The basic answer is that the fundamental accounting equation is the relationship between assets and liabilities plus owner's equity. Yes, you're probably still scratching your head because that probably doesn't mean that much to you at this point. But let's break this down so that we learn a little bit about what is each of these components and how they work together. So we'll start by talking about what are assets. Well, basically assets are anything that is of value to the company. Most of the time we think of this as things that the company owns, trucks or a building, but this can also be things like cash or even money that is owed to the company in the future. They're going to be of value, so we consider them an asset. What are liabilities? Well, a liability is some form of a debt. This is something like a piece of equipment that we go out and purchase on account, and we owe that money for the equipment to this vendor. We're going to at some point have to pay that debt, and so we keep this as a liability because we know we're going to have to pay it in the future. Owner's equity. Owner's equity is a term that we use to describe the financial interest. If the owner has invested money into the company, we want them to have that represented as their financial interest. In a sole proprietorship, we do this with what's called the owner's capital account. So, in accounting terms, the assets must equal the total of liabilities and owner's equity. That is what makes this an accounting equation. We can line this up so that the assets are on one side of the equation, and then the liabilities plus the owner's equity are on the other side. In Chapter 3, we'll go into more about how this works and why it's structured the way that it is. But for right now, we just want you to be able to identify what accounts are asset accounts, what are liability accounts, and what are owner's equity accounts. We're going to see that because this is set up like an equation, if we know two of the parts, then we can easily determine what is the third part. So let's look at this from the transaction level. If Carolyn Wells withdrew $100,000 from her personal savings and put it into a checking account for the business, then that is going to be our first transaction to establish Wells Consulting Services. Carolyn and Wells Consulting Services is an example that we're going to use in chapters 1 through 6. In this case, we've got to make sure that we're separating her personal funds from the business funds. This is critical in a business and a mistake that some new business owners make. So, in this case, we have the business receiving $100,000 in property or assets in the form of cash. At the same time, we've got to represent Carolyn Wells' $100,000 in financial interest as part of the owner's capital account. So this is what this will look like if we were to draw this with a basic equation. On one side, we've increased the balance of the cash account by $100,000. And on the other side, we've increased the balance of Carolyn Wells' capital account by $100,000. And obviously the equation balances on each side. The next transaction is when we're going to actually start doing some business and go out and purchase some equipment using some of the cash that was just invested. In this case, we're going to purchase $5,000 worth of equipment, so we're going to increase the balance of that, and then we're going to decrease the balance of cash since that's how we paid for this. Now, equipment is also considered an asset. This is something of value to the company, so it's going to stay over on the left-hand side of the equation under the property category. Now we can see that the balance is still $100,000 on both sides, even though we've exchanged cash for another type of asset. In the next transaction, the company is going to purchase $6,000 worth of equipment, but we're going to do that on account. So we have to increase our balance of the equipment account by $6,000, but this time we're going to add a liability to the other side of the equation. This is someone who has extended credit to us, and it's a liability because we're going to have to pay this in the future. The equation is still in balance because we added the equal amounts to both sides. Next, the firm is going to purchase supplies, and they're going to use $1,500 worth of cash to do this. So, again, we're exchanging one type of asset for another. We're decreasing the balance of cash, and we're increasing the balance of our supplies. No change in the equation balance since both transactions involved accounts on the left side of the equation. In the next transaction, the firm is going to make a payment of $2,500 towards the account in which they purchased something earlier. In this case, we're going to decrease the balance of cash because we're actually paying somebody, and we're going to decrease the balance of our accounts payable since we no longer owe that $2,500 to the creditor. The decrease in both sides of the equation is reflected by the cash reduction and the reduction in what we owe. In this case, we're going to pay rent. This time we're going to do this for $8,000, and we're doing this in advance. This opens up a discussion around what is called prepaid rent. This is something that is different than how we're used to dealing with things in our everyday lives. When we pay rent, we go and write a check and expect that to come immediately out of our account, and we have rent for that particular month. In business, you can prepay your rent not just 1 month, but several months ahead. In this case, if we look at $8,000, we may be paying $2,000 a month worth of rent, and we're paying 4 months worth of rent at once. Now, this is an asset to us. We have it on the left side of the equation. The reason we have that there is because it's owed to us, and so it is of value. The easiest way to understand this is if we were to take money out of our checking account and put it onto a gift card. We still have the money in our possession, it's just in a different form. It's the same thing with the prepaid rent. At the beginning of the month, we have all of that rent ahead, and we haven't actually used any of it up. At the end of the month, we will have used 1 month's worth of rent, and as part of what we call the adjusting process, we're going to go in and reduce the balance of that rent and incur an expense. This is something that we'll get to in great detail in Chapter 5. For right now, what we need you to understand is that if you trade cash for something that is prepaid, it is going to be an asset, and we'll use that up over a period of time. The balance of the equation is still the same. Next, the firm goes out and actually does some work, and for that they earn $36,000 in cash. Now in this case, we're going to increase our cash balance by $36,000 because we actually did work and received cash for it. But at the same time, we've got to increase what is called revenue. Revenue is one way of money coming into the company. As we saw in the first transaction, the owner putting money into the company was one way to get money in there. But now that we've gone out and performed services, we want to keep track of how much work we've done and what we were paid for that. So our revenue account, often called fees income when we're dealing with a consulting service, is going to have to be increased by $36,000 as well. By doing this on both sides of the equation, the actual transaction makes sure that everything is in balance. Next, we're going to go out and perform services, but this time, instead of the customer paying us cash, we're going to allow them to charge it to an account. We're extending credit to our customer, and we're expecting to receive that money from them in the future. So we increase the balance of our revenue account by $11,000, and then we increase the balance of an account called accounts receivable. This is where we keep track of all the money that people owe us. So when we do a job for them and allow them to pay us in either 30 or 60 days, we're giving them credit, and we expect to receive that in the future. Now, when the future arrives and they pay us, what we're going to do is increase the balance of our cash account because they've actually given us a payment for that account, and then we're going to decrease the balance of our accounts receivable because they no longer owe that money. Next, we're going to pay our salaries, in this case $8,000, and when we do that, we're going to decrease the balance of our cash, but this is now an expense for us, so we need to keep track of how much money we're spending on different items in the business. In this case, we're going to keep track of the salaries in our expense account. Expense accounts, like revenue, are part of owner's equity, and so the accounts accounting equation stays in balance because the transaction took place on both sides. Next, the firm pays $650 for utilities. Similar to salaries, this is going to be an expense, so we're going to increase the balance of our expense account by $650 and decrease the balance of cash since that's how we paid for the utilities. Finally, we're going to record a withdrawal from the owner. The owner is going to take out $5,000 worth of cash to use for personal expenses, and in that case we need to decrease how much of financial interest they have in the company. So we're going to reduce the balance in their capital to reflect that. How this process takes place is a little bit more involved, and we'll learn more about that in Chapter 3. That concludes our explanation of the accounting equation. Thank you for watching, and we'll see you in the next video.